The Fed funds rate has jumped significantly, as you can see here, 3 to 3.25%. They expect to jump up to 4.25% to 4.5% before coming down. You kind of see that over on the right-hand side on the dotted line. The Fed is saying quite explicitly they are not going to blink. They are going to take this inflation threat seriously, which kind of frankly just gets into some game theory. It sort of behooves the Fed to take a hardline stance on inflation for reasons including that they have taken heat. They caught some heat earlier this year about being slow to react originally. And if the concern is in fact those core inflation numbers, which it seems like it is, then the Fed has also really got to take a hard line here. So, big picture, the Fed expects to continue down this path of rate hikes through 2023. It is, in my view, doing the right thing. Doesn't necessarily mean it's pleasant, and there's not going to be some consequences. But there's still perception is the Fed is still kind of stuck between a rock and a hard place between inflation and economic growth there. But this federal funds rate is a pretty important indicator of what that future path may look like, and by extension, what might be driving the volatility a little bit more here. Fed funds futures. As far as what the market expects to do, the market has actually been pretty accurate when predicting what the Fed will need to do this year. The market's kind of beating the Fed to the punch when adjusting its own conclusions. Fed funds futures are an important real-time gauge for what the market expects from the Fed. This chart shows that implied rate in the dark blue line across the middle, and then the light blue bars show how many 25 basis point hikes that implied rate would translate into. In other words, what's the number of quarter point Fed rate hikes the market expects to see at future Fed meetings. Right now, left-hand side, dark blue line showing it at just under that 3.9 level today on the funds rate. And the market expects in the light blue bars 3 25 basis point hikes or 0.75% in November at that November meeting. And then moving one bar to the right, another 50 basis points in December, and then 25 basis point hike in February, and so on. So tapering off is the point before starting to roll over, looks like next May. Excuse me. So big picture sense, what's really driven all of the volatility lately in both stock and bond markets is the closing of that gap between the light blue bars and that dark blue line running across the middle there. When those numbers change, it kicks off a whole other round of volatility in the equity market specifically. At least that's what pay most attention to here. Every equity analyst on the street, once these numbers change, has to really go update their models with a higher discount rate. And if you've ever played around with any sort of models at all, that can dramatically shift valuations lower. And so, you can see some big moves in the stock market, at least among the group of investors who definitely pay attention to valuation, and that's a lot in times like this. So to be clear, this particularly this chart can change dramatically in short periods of time, but the overarching point is that the Fed is expected by the market, to keep rates high through 2023. Excuse me. all of that also impacts the yield curve, really the entire yield curve. The yield curve is the graph that shows the relationship between the short and long-term interest rates on the bonds issued by Uncle Sam. Normally, now, longer-term bonds should pay higher interest rates, right? There's more risk in holding those bonds for longer time periods, and you as an investor, you as a buyer of those bonds, should be compensated for that risk with higher interest rates. When the curve is inverted, it means short-term rates are higher than longer-term rates, and it's typically caused by concerns of an economic slowdown that might be coming around the corner. More demand for long-term bonds than short-term ones, sort of an any port in the storm kind of thing. And that buying of long-term bonds pushes those bond prices up and lowers their yield. So the point is the slope of that line inverts and it tilts to slope down over time, kind of like in the top section of this chart rather than at the bottom, the red line at the bottom. So to be clear, this is also a highly unusual looking yield curve. It kind of bakes in everything we've talked about so far. You've got inversion between the shorter term rates and the 10-year, and now it's inverted all the way out to the 10-year. The timeline or the time series, I guess, that was tried to capture in here, that's also of note. You can see in the bottom curve, the darker red line, how that yield curve looked last year, and kind of moving up the page, you can see how dramatically these rates have risen. And then you can see the curve bend as we hit the end of Q3, and now that left end has kind of kinked up even higher since then. All goes back to the point that we're seeing this 40-year trend change in the bond market as I speak, really. A couple more things on consumer behavior here. This is the slide that, it's probably not obvious. In my mind, it's a slide that answers the question posed at the beginning most viscerally, I guess. The question being, should I go to cash? I have not any changes to my answer to that all year, in spite of all the other volatility. And what I'm trying to get at here is, look, the problem is that cash is exactly what is being eroded by inflation. Cash is the last place you want to be. Maybe you get a little higher interest on those CDs than earlier, or on that checking your savings account. But once you factor in that 8% inflation, in real terms, you've actually lost purchasing power on the cash that's been put in there. And there's really sort of no way to sugarcoat it. Cash has no ability to make up those losses. You really got to invest in equities specifically, and then, frankly, be patient and wait for that rebound, to be honest. Mortgage rates, they have spiked this year due to really rising interest rates across the board. As you can imagine, that is slowing housing activity. The cost of borrowing rises, and housing, which is sort of on the sort of leading or bleeding edge of Fed policy in these interest rate hikes. That again is also kind of the point, to cool off demand in that housing market specifically, by raising rates at the Fed. But yeah, just good shot here of what 30-year fix looks like over a long period of time. S&P Case-Shiller Index, it is clear that we are seeing a slowdown in housing. That is, again, a key area of the consumer balance sheet. Also starting to see a slight decrease now in housing prices as per this. This is the last round of Case-Shiller numbers, as well as seeing a decrease in other measures of housing activity. The S&P Case-Shiller index is really an important measure of national housing prices. This particular snapshot of it uses a 20-city index. And yeah, you can tell home prices, they rose to record levels recently, but have just now started to soften. Also seeing building permits come down, housing starts coming down, existing home sales coming down. Got a slide. Here we go. Yeah. Existing home sales have softened this year as rates have risen as well. And just as a point of fact, rising mortgage rates could continue to put a damper on the housing market. Here's, I think, the way to think about this, at least as an equity investor in the stock market. I mean, again, clear that there is a slowdown in housing now. That in of itself tends to really bring back bad memories for a lot of people. It's natural to think about 2008. The question, though, of whether or not we should be concerned about a housing slowdown when it comes to the stock market is really the question of whether or not there's anything systemic going on behind the scenes. Again, this is not anything, not even in the same universe as what we saw in 08 and 09. The foundational problem that wrecked the economy in 2008 was really leverage. Debt at banks, you may remember, collateralized debt obligations, CDO squared. A lot of folks that really couldn't afford it buying second, third, sometimes fourth investment homes. It was a leverage problem that was absolutely concentrated in and exacerbated by housing. We are not seeing that today at all, is my point. Debt across households is still at very manageable levels, and in part because people's personal balance sheets they've been built up pretty significantly going into this. That's a function of COVID stimulus money that went out. It's a function of gains in the prior market. I guess a lot of people seem to be trading crypto, and maybe they got out and booked some of that. I don't know. My point is that a slowdown in housing, the one that we're seeing now, it is just not even in the same universe as a 2008 scenario.